video, we're going to post journal entries from our general journal, which was handout 3.1, to our general ledger or our T accounts. Recall our general journal keeps track of transactions sequentially by time, everything that happens, where our general ledger or our T accounts accumulate the transactions for each account in one place. Notice we have beginning balances in our T accounts. $3,100 in cash, $900 in supplies, $21,000 in plant, property, and equipment, a notes payable of $15,000 and common stock of $10,000. These are the balances in our T accounts from the transactions back from Chapter 2. And those were our balance sheet transactions. Let's go ahead now and record our journal entries or post our general journal entries for our income statement transactions to our T account. The first one we have is a $40,000 debit to cash and a $40,000 credit to revenue. Again, one thing we want to notice, the letter A, and it doesn't have to be the alphabetical letters, but there'll be some sort of cross-reference telling us if we were to look at this $40,000 entry or posting to our T account for cash, we would know where to find the other half of that transaction by going back to our general journal and seeing that it involved a credit to revenue. Let's go ahead and finish off posting our journal entries. Journal entry B, we had a $20,000 debit to accounts receivable and a $20,000 credit to revenue. Transaction C, we had an $18,000 debit to cash and an $18,000 credit to accounts receivable. Transaction D, we had a $1,000 debit to cash and a $1,000 credit to unearned revenue. Transaction E, we had a $1,000 debit to unearned revenue and a $1,000 credit to revenues. For transaction F, we had a $16,000 debit to wage expense and a $16,000 credit to cash. Transaction G, a $3,000 debit to prepaid insurance, a $3,000 credit to cash. Transaction H, there was a $9,000 debit to prepaid rent and a $9,000 credit to cash. For transaction I, we had a $250 debit to telephone expense and a $250 credit to accounts payable. And finally, for transaction J, a $500 debit to utility expense and a $500 credit to cash. Once we've posted all of our general journal entries to our general ledger, we will want to total up our general ledger accounts. Notice in this case, we have a $28,500 of credits to cash, and make sure we're picking up our beginning balance as well. And we've got $62,100 in debit to cash. And of course, that means our debits exceed our credits. And we total the two and we net to $33,600 debit balance for cash. And we've got to hope that all of our assets have their natural or normal balance, which is a debit balance. Supplies were at $900. Accounts receivable, we had $20,000 in debits, $18,000 in credits, leaving us with a $2,000 debit balance. Prepaid rent, $9,000. Prepaid insurance, $3,000. Plant, property, and equipment, $21,000. Accounts payable, $250. Notes payable, $15,000. Unearned revenue was zeroed out. Common stock is at $10,000. Our total, we have nothing for retained earnings yet. We'll pick that up in a later chapter. We have total revenues of $61,000, wage expense of $16,000, utility expense of $500, and telephone expense of $250. Once we've totaled our general ledger accounts, or in this case our simple T accounts, we will post these ending balances, the $33,000, the $900, the $2,000, the $9,000, to our trial balance, and then we will prepare our financial statements. In this case, it will be an unadjusted trial balance because we have not yet prepared adjusting journal entries, which we'll discuss in Chapter 4. But let's go ahead and post those balances to our T accounts, or from our T accounts to our unadjusted trial balance. We had $33,600 in cash, $900 in supplies, $2,000 in accounts receivable. We had prepaid rent of $9,000, prepaid insurance of $3,000, plant, property, and equipment of $21,000. Then in terms of liabilities, accounts payable were $250, notes payable were $15,000, unearned revenue was zeroed out. We had $10,000 in common stock and nothing yet for retained earnings. Our total revenues were $61,000. We had wage expense of $16,000, utility expense of $500, and telephone expense of $250. We want to make sure our trial balances. We add up all the debits, and we've got $86,250 in debits. And we've got to hope that when we add up all of our credits, it also equals $86,250. If it doesn't, that means we've made a mistake somewhere in posting from our T accounts to our trial balance, or we've made a mistake recording journal entries or something somewhere along the process. Let's now go ahead and prepare our preliminary income statement. We had revenues of $61,000. We have wage expense, utility expense, and telephone expense. We will pick those up. Our telephone expenses, or wage expense is $16,000, utility expense $500, telephone $250 for total expenses of $16,750. And of course, then we can calculate net income. And net income is simply our revenues minus our total expenses. We have net income of $44,250 and a profit margin of 73%, and that's simply our net income divided by our revenues. In Chapter 4, we will post or prepare adjusting journal entries, which is sort of our final step in our accounting cycle before we prepare then, of course, an adjusted trial balance and our final income statement and financial statements.